Hello and welcome to Money 2020 Hindsight, your cheat sheet for the least you need to know in fintech today. I'm Nick Holland, Global Head of Research at Money 2020. Today we're going to discuss FTX's rumored acquisition of Robinhood, Goldman's raise to buy Celsius assets, and of course the money shot. First, let's start as we always do with Money 2020 Hindsight, which is the number of the day with Mickey Tesfaye. Mickey, so what is the number of the day, please?
Hey Nick, nice to see you. My number of the day for today is 648 million.
All right, so just what is that, sir?
So as you might remember, back in May, Sam Bankman-Fried, CEO of FTX, disclosed that a company he controls, Emergent Fidelity Technologies, had acquired a 7.6% stake in Robinhood, and he paid around $648 million for that stake.
All right, and so obviously he paid for that. So I mean, we've heard about this Bloomberg acquisition of Robinhood. So tell me a bit about that, if you will, as well.
Yes.
Or this alleged acquisition, rather.
Yeah. So this number is interesting because yesterday it emerged, according to Bloomberg, that Sam Bankman-Fried, who is FTX's CEO, is exploring. His company rather is exploring the potential for an acquisition of Robinhood, and this is from sources who are close to that potential deal. And FTX is deliberating internally about how they could buy the app-based brokerage firm, and even though the news hasn't been made public, and there have been no formal approaches from FTX around this potential deal, the early acquisition suggests that there might be something in the works here. And actually, he went on to state in an email to his employees that we are excited about Robinhood's business prospects and potential ways we could partner with them. But he then went on to categorically deny any potential M&A, saying that despite all of that, there are no active M&A conversations with Robinhood. Yeah. And it's interesting because, as part of the wider sell-off we've seen in the markets, Robinhood has probably been one of the biggest hit. They've lost about 3/4 of its value since their initial IPO. And since then, across this year, they've lost something like 87% of their valuation. And on the news of this potential acquisition, actually, we saw the company's stock rally around 14% to close at $9.12, which lifted capitalization.
I think this is really interesting for a couple of reasons. I mean, this could be conjecture, but what's almost paradoxical here now is you've got a crypto that is bailing out sort of a traditional fintech potentially. So it's kind of a reversal of fortunes to some extent. So you've got, effectively, FTX may be, I mean, again, this is conjecture. I mean, they may be coming in, but also, Robinhood's reputation has not exactly been stellar. So FTX might actually be sort of legitimizing and raising the credibility of Robinhood, I think.
Yeah, I think that's really actually one of the things that's so interesting about it, right? Like, I think for a long time, the kind of narrative has been around the need for crypto companies to legitimize themselves. But in this instance, it does seem like the crypto company is the one that's going to bring, that kind of approval about we do business the right way. So I think that part is very, very interesting to me as well.
Yeah, me too. Anyway, so let's move on. Let's talk about Goldman and Celsius, because again, another example of, there's been a lot of doom and gloom, over the last few weeks about, again, sort of the crypto winter coming and all that kind of stuff. But there's some interesting news about a potential bid to acquire assets from Celsius. So yeah, tell me about that if you would.
Yeah, so we've had a couple of reports emerging, and I think it was first reported by CoinDesk, which said that Goldman Sachs is putting together an estimated bid of around $2 billion to acquire the assets of Celsius Network, which is ailing at the moment. And what's really interesting about this story is that if it goes through, it really does challenge this kind of narrative of doom and gloom, as you said, because it would be probably the biggest effort we'd have seen from a traditional or established financial institution to take advantage of the current market crash we're seeing. And I guess, the question is, why would they want to do that? And the reality is, if they did manage to raise this money and acquire those assets, essentially Goldman will be able to acquire Celsius's various crypto holdings and assets at discounted price. So, makes a lot of financial sense.
And again, another Sam Bankman-Fried piece of news which ties into this again was obviously you had BlockFi getting a $250 million credit line from FTX recently as well. So I mean, there seems to be quite a bit of bailing out going on, which is again evidence I think that the alleged crypto winter is maybe a little bit of a flash in the pan. Who knows?
Yeah, I mean, I think that's one interesting takeaway from it. Really, the other interesting takeaway for me is who isn't Sam trying to save at this point?
he's like it's like crypto Batman, maybe he's sort of saving people, or crypto Oprah, you get a bailout, you get a bailout. Anyway, he's obviously very front and center, a lot of things going on there. So keeping on the theme of again sort of the I guess FUD factor that's been out in the market for a while, but also I think really sort of maybe level setting. I'm going to bring in Rachel Morrissey again. Rach, I'd love to have you back here on the show. It's fantastic to have you. So let's talk about a little bit this Medium article that I came across, and let me read a little bit if I may. So this was an article from Alex Kantrowitz on VC still spending like drunken sailors, something that I read this morning. So it goes, the S&P 500 is in the gutter, the tech-heavy NASDAQ is doing worse, IPOs are struggling to clear their listing prices, and some tech stocks like Uber are trading well below their private market value. Yet venture capitalists are continuing to throw money at tech startups, and 2022 is shaping up to be the second most active year of VC funding on record, right behind 2021. The public market slowdown, which limits the return these VCs can hope for, isn't meaningfully stalling their activity, contrary to the popular narrative. Tech is still well up, said Carl Stanford, a senior analyst at PitchBook, who covers venture capital. We believe that this will be the second highest year for deal count. 3,600 funds have closed in the US since 2018. All those funds will be in their investment cycle, so it should be a strong year. So, I mean, there's a lot of kind of apparently dry powder out there. You've got, obviously, the 2021 was the most active year for startup investing. VC had 230 billion of dry powder on hand then. But this year they've already raised 106 billion. So, again, back to Stanford, he says tons of capital is available for tech. So, right, I'm going to bring you in here. And, there's been a lot of, I'd say, pearl clutching articles in some of the mainstream media about, the sort of fintech having a tough winter and it's going to be terrible for VCs and startups and all that kind of stuff. This seems to be very contrary evidence to this alleged, fintech entering a new ice age. So, I mean, what is it? Who do we believe on this?
Well, I mean, I think we'd be foolish to believe that we're entering a fintech ice age. Fintech there's always going to be certain sectors that tech is more trusted and less or more advantageous than others. There's going to be windfalls and shortfalls. There are certain companies that we're seeing laying off a lot of workers because we just came out of a pandemic, or we're attempting to. And during the pandemic, it really changed the nature of the flow of supply and the demand and what kinds of things were necessary for us to work. And things like Klarna or Amount or some of these others you're seeing that grew tremendously during the pandemic when the demand was high for their kinds of services are having to lay off and kind of tighten the belts and reconfigure their business strategies. But then you're seeing things like cloud that are just skyrocketing. Anything around digital transformation and the core is still going. I just don't see this ice age that they're talking about. And as far as the VCs, they raised a ton of capital during the pandemic because people were seeing the advantageous nature of fintech for accessing accounts. You were seeing a lot of consumer demand. You were seeing a lot of B2B demand. We're still looking at a lot of B2B transformation. And I think that whether the markets are riding high and the exits look easy and, the SPACs have slowed down, with all of that,
right.
If you're thinking long-term, this is a great time to invest, especially if you have this much capital. You don't want it just sitting around. You want to put it to work. And this is actually, And I mean, you want to buy if you can buy right now, because the things will even out. And I think that they, and VCs always do a bet hedging, right? There's
Right.
certain investments that they have that are they're hoping for the big payout. There's ones that they're not as concerned whether there's a big payout. They only really need one or two to hit to make everything back and happy. I don't think that, I think that this idea that fintech is dead or drying up or having its comeuppance is silly.
Yeah, I mean, I think, to your point, I think again there are well, a few points. I mean, fintech is very hard to put fintech into one category. There's so many variants within that. So I mean, to put that sort of very nebulous moniker on fintech, given the variety of areas it covers, is a little bit overkill. Secondly, I think, I mean, certainly we discussed this earlier on, but I think there's been kind of the thin end of the wedge in terms of consumers being introduced to fintech, and you know, there's now a new familiarity with apps and trust in that ecosystem, so maybe a greater willingness to try new things. I mean, there will be an inevitable thinning of the herds. I mean, some apps and some businesses just won't make the cut because they're maybe too similar to others, or they haven't got the necessary scale, or their, you know, the UX doesn't, you know, have the same attributes that people are looking for.
Or they won't be saved by Sam Bankman-Fried for the
that as well. I mean, you can't bail out everybody, clearly.
Yeah, you gotta pick and choose.
Very altruistic of him, but I mean, I think the other thing as well is, I mean, again, you know, it's not just about fintech. Fintech isn't standalone. You've got to, I mean, you mentioned obviously sort of cloud, which is a, you know, it cuts across fintech, but it cuts across everything. And as we're moving to cloud, we're considering other aspects of, again, the ecosystem, like you know, smart tech. We're looking at reg tech. We're looking at, I mean, again, as fintech evolves, we're looking at the identity ecosystem and the need for identity to play into this. So it's not, you know, again, I think putting this sort of fintech wrap around it and thinking, oh, fintech is, you know, it's you know, the honeymoon's over here. Again, I think is some unnecessary pearl clutching, as I mentioned earlier. So it's like, just call your jets, people. We'll be all right. Mickey, over to you. I mean, what are your thoughts on this?
Yeah, I mean, I think both you and Rachel made really good points. I think, you know, the point you made about the fact that what we're seeing right now is industry agnostic, right? We're seeing sell-offs across the market. So I think the kind of idea that fintech is, you know, doomed is pretty problematic to me. I think also, you know, Rachel made a really good point right earlier on in terms of VCs are sitting on a lot of cash, and I think in part actually, you know, part of, you know, if you're a VC and you've got a lot of cash, there's a good time for you, but also there's a good time for you to negotiate and push prices down further, right? So you want to hold your money back a little bit until you're in a better negotiating position too. I do think, you know, a lot of the consumer side, you know, companies focused on providing retail consumer services and products, they might struggle a little bit because, yes, certainly they might have been inflated. But as both of you pointed out, I think infrastructure, there seems to be a lot of interest still. Today, even, you know, just even in the wider area, we saw Conversion Capital raised 122 million for its third fund. And I think that more than doubles its previous fund, right? So there is still money available. And, you know, what they said too is they're going to be looking at early stage fintechs and infrastructure. And I think just a final point I would make also is, you know, fintech came out of a crisis, and these are the kinds of situations where parts of, you know, like you get some of the bloated companies maybe getting trimmed a little bit, but also enabling a bit of innovation and new blood to come into the industry too. So I think there is still good opportunities to emerge from this.
So
there's one other point I just want to quickly make, which is a lot of the investment is also going into emerging markets. And, you know, there's a lot less risk there in some ways, that the growth is a little bit more inevitable. And a lot of this, you know, to Mickey's point about, you know, pushing the prices down, this is not necessarily a place where they need to push the prices down, because in those markets, it's already, there's waves that happen in fintech typically. I mean, in all tech, there's waves of innovation. And I see a lot of money going towards emerging markets because the waves are a little more predictable. And we can see what's happening there.
So in summary, rumors of fintech's demise have been greatly exaggerated.
Maybe.
Yeah, okay, great. Well, folks, as ever, thanks for watching, viewers out there. Rachel, thanks again for having you as our guest, and Mickey, as ever, thanks for being my co-pilot on today's show. Thursday, we're going to have Zach Anderson-Pettit on to discuss OnlyFans and the sessions that we had at Money20 Amsterdam, as well as some of the things that are on the agenda for our upcoming show in Las Vegas. So in the meantime, keep well. See you soon. I'm Nick Holland, and cheers for now.